One of the biggest challenges that realtors face in managing their own money is deciding, how do I figure out which investments to go into, and how do I go about analyzing how much risk I'm willing to take. So to talk about how to identify the investments we want and how much risk we're willing to take, we're with Victoria Gillespie of the Realtors Federal Credit Union, a division of Northwest Federal Credit Union.
I guess for starters, what I suggest is we need some kind of tool to talk to realtors about to lay out what the investment choice is. One of my favorite tools to use is the financial triangle. It's a very simple visual that helps the realtor or the member walk through different investment choices. The one that I use most frequently has 4 different levels, with the foundational level being the most conservative, or the guaranteed level. We would view that as least risky. It would be your credit union deposits, those that are actually guaranteed by the NCUA, or it would be a bank deposit that would be insured by FDIC. So that ground level is the guaranteed most conservative. When you go to the next level, we would be looking at things that are conservative still, but not guaranteed. So that might be government funds, municipal bond funds, anything that has a strong government backing. The third level, being less conservative, again, we would have higher rates of return, typically the opportunity to earn as you go up. So that next level, less conservative, are your typical stock investments in any blue chip companies. Another important one is not just the individual stock, which would be a mutual fund. A mutual fund is merely taking all those blue chip stocks, potentially, and pulling it and buying little bits of ownership in different companies, and that's a mutual fund. But it does take on more risk, but what's neat about the mutual fund is you've created diversification within that product. And then the very top level of the financial triangle is the very least conservative. It's not typically where you would see a financial institution providing investment advice for, and it's very speculative in nature. Things like gold, silver, commodities. You'll hear people who trade pork bellies. That's not something that we're going to advise in our investment division, but they are available, and that is the most risky. That's the top of the pyramid, which would potentially gain the highest rates of return, but you've taken on the greatest amount of risk at that level. What I want you to keep in mind is there are inherent risks. If you chose only to do a guaranteed product, you have other forms of risk, like inflation risk. So if today you have all your money in an account yielding you 1%, right? Mm-hmm. And historically, inflation is about 3%. What do you think that means? Your investment is not keeping pace with inflation. Mm-hmm. So you are, in theory, 2% off of your buying power. So that's where it becomes very important to look at all types of risk, to make sure that some portion of your portfolio is outpacing inflation, and to really have a nice diversified investment strategy.
So it sounds a little bit like what you're saying is, talk a little bit about this. You set aside your funds for your investing, and you might want to invest in a mix in this triangle.
Absolutely. If you look at where you keep your funds right now, and you don't have some portions of your monies, and it may not be large amounts, you may still be working on protecting your 8 months of living expenses. You do want to begin some kind of systematic dollar cost averaging, possibly, into the market, so which a well-balanced portfolio will touch at each level to some degree. You may never make it to the 4th level, that very speculative, but something more than the ground level will probably be needed to prepare you for your retirement years to keep up with the cost of living. What we'd like you to keep in mind is, as you go up the financial triangle with your investment selections, and you have the ability to potentially earn higher rates of return, that you remember you need a much longer time frame to ensure a better chance of increased returns. To give you the example, we know that the stock market fluctuates up and down every day. If you can say, I have a 7-year time frame, a 10-year time frame, you can sort of mitigate some of the fluctuation risk and thereby take on a higher rate of return.
The Realtors Federal Credit Union was launched several years ago because it's it tries to provide products and services that are most useful to realtors. So can you talk a little bit about what the products that the credit union offers? Where do they fall on this?
Most of our investments here at the credit union are handled by a division of ours, or a subsidiary, which is Northwest Capital Management. And they have licensed, trained professionals that sit down with our members, and they go through a complete profile. They talk about time frame to retirement, comfortability with risk. I mean, they literally complete an extensive risk profile. Based on that time they spend together, they then go and decide on which investment selections are appropriate for this person. Some of the questions they would ask is, how many more years do you think you'll work until retirement? So then you know how many more income producing years you have, so that you know you can still be accumulating. They'll ask you, what do you think you'll do in your retirement years? Do you think you'll stay in this area? Do you think you'll move to a different cost of living area? Those types of decisions will impact how much you need to accumulate. So once they go through the whole profile, they talk about your risk tolerance, they'll literally come up with a recommendation for you that will help create a more diversified portfolio so that you can spread your investment selections across varied risk levels.